The date is January 2025. The location, Los Angeles. What you are witnessing in the canyons of Southern California isn't just a localized natural disaster. It is a moment of total financial reckoning for the fifth largest economy in the world. For decades, the public was told that the California real estate market was an invincible machine, backed by a robust private insurance safety net. We were told that as long as we paid our premiums, the risk was effectively managed by the world's most sophisticated models. But today, the math has officially broken. The Golden State is facing a structural deficit that no amount of political optimism can bridge. State Farm, a titan of the industry that has anchored the California market since 1928, has reached a point of unprecedented instability. In the wake of the 2025 Los Angeles wildfires, specifically the Palisades and Eaton fires, current estimates place industry losses in the range of $25 to $40 billion. These aren't just abstract figures. They represent the sudden, massive liquidation of insurance reserves. State Farm General, the subsidiary specifically serving California, has taken the brunt of this impact, reporting $7.6 billion in total claim payments for this single event. But here is the detail they don't want you to notice. To prevent a total collapse, State Farm's parent company was forced to issue a $400 million surplus note in June. That is essentially an emergency transfusion of cash, just to maintain the subsidiary's license to operate. Shortly after, S&P Global lowered State Farm's strength rating to A-. This is a critical threshold. If it drops any further, homeowners with mortgages backed by Fannie Mae or Freddie Mac could technically be in violation of their loan terms because their insurer no longer meets quality standards. If you live in a zip code touching a high fire severity zone, you aren't just looking at a higher bill. You are looking at a structural seizure of the very system that makes home ownership possible. To understand why your home equity is effectively evaporating, we have to look at the ghost in the machine. Proposition 103, passed by voters in 1988. This law was designed to protect you from rate hikes. It was a triumph for 20th century stability. But today, it has become a regulatory cage. The law traditionally forbade insurance companies from using forward-looking, scientific catastrophe modeling. Instead, it forced them to set 2025 prices based on a 20-year rolling average of historical losses. But the physical reality of the state has fundamentally shifted. In the last decade, 13 of California's 20 most destructive fires have occurred. In a world of escalating volatility, relying on a 20-year historical average isn't just conservative. It is a mathematical trap. It's like trying to navigate a high-speed turn while looking exclusively in the rearview mirror. Look at the granularity of the collapse, the supply chain, and the labor market. Inflation isn't just a headline, it is the tangible surging cost of lumber, copper, and fire-resistant materials. When a structure is lost today, the cost to replace it has surged 40% beyond 2022 levels, yet, for years. The regulatory framework restricted the rate increases necessary to cover these liabilities. The result is a market where for every dollar collected in premiums, insurers were paying out significantly more in claims. In any other industry, this is known as a failing business model. But the residential market is only the first domino. The real systemic threat, the one that stops the heart of the economy, lies in the commercial sector. State Farm has moved to non-renew 30,000 residential homes. But the more staggering move, their total withdrawal from the commercial apartment market, affecting 42,000 policies. This is a total exit from a critical pillar of California's infrastructure. When a primary carrier exits the commercial market, it triggers a chain reaction in the global credit markets. Every apartment building in Los Angeles, San Diego, and San Francisco is tied to a mortgage. Those loans carry a non-negotiable requirement for insurance. If the private market disappears, these buildings become, technically, Uninsurable. In the world of commercial real estate, uninsurable is a synonym for default. Within the next 12 months, this will cost the average renter an additional $200 to $400 every single month. Property owners, unable to find traditional coverage, are forced into the surplus lines market, where they pay 400% markups. These costs are not absorbed by the landlords. They are passed directly to the tenants. You won't see insurance crisis on your monthly rent statement. You will simply see a facility surcharge or a base rent hike. This is how a localized insurance deficit transforms into a statewide cost of living crisis that hits the middle class the hardest. Let's look at the numbers the official briefings omit. In February, the California FAIR Plan, the state's insurer of last resort, was authorized to issue a historic $1 billion assessment on private insurers. This was an emergency measure to cover the massive surge in claims from the January fires. But where does that $1 billion actually come from? It doesn't come from a vault in the Midwest. Under the new regulations, insurance companies are permitted to recoup these assessments by charging temporary supplemental fees to you. Currently, the FAIR Plan is carrying a total potential liability of $700 billion. To put that in perspective, in 2018, that number was only $50 billion. That is a 1,300% increase in liability in just 7 years. The system is now so overloaded that the plan of last resort is becoming the primary insurer for entire counties. The FAIR Plan was never designed to hold $700 billion in risk. It doesn't have the capital reserves of a global insurer. It relies on the ability to tax every other insurance company in the state if it runs out of money. But what happens when those companies are already leaving? To afford the projected insurance spikes, the average California worker earning $35 an hour will need to work an extra 144 to 180 hours per year just to maintain their current level of protection. That's nearly an entire month of labor dedicated solely to paying for the increased cost of risk. This is an effective 8% pay cut for the entire California middle class, mandated not by an employer, but by a failing fiscal architecture. The governor and the insurance commissioner are pushing the sustainable insurance strategy as the final solution. The strategy allows insurers to finally price for the cost of reinsurance, the insurance that insurance companies buy to protect themselves. This sounds like common sense, but in reality, it means rates are about to move significantly higher to match global market prices. In exchange for this, insurers must return to the wildfire-prone areas they abandoned. But capital is cowardly. It goes where it is protected. And right now, the California regulatory environment still feels like a trap. If the state forces companies to write policies in high-risk areas as a condition of doing business, those companies will simply choose to do business elsewhere. The urgency we see from Sacramento today isn't just about the environment. It's about the fact that the financial ledger no longer balances. The exit of the state's largest insurers is a final alarm for a system under extreme pressure. We have reached the limit of how much risk can be hidden behind regulatory barriers. You cannot regulate the cost of raw materials. You cannot legislate away the physical risk of the land. And most importantly, you cannot ignore the math forever. The era of predictable fixed cost safety is over. As we move into 2026, every resident must realize that the Golden State is no longer just a place to live. It is a high-stakes, financial risk. Prepare your capital, understand your exposure, and recognize that in the new economy, safety is no longer a guarantee. It is an expensive, fluctuating commodity. The check has officially bounced.